Welcome back, Rob. Thank you for joining us again and joining this thought leadership series, which is the Value Multiplier with Rob Connell. I'm Nuno Godinho, and if you're raising capital, leading a funding round, or thinking about restructuring a business for the next market cycle, today's episode is a must listen. Today is about that smart fundraising, that proper structuring, and also the building of trust with the people who back your business. So Rob has raised capital in good markets and bad, from public company budgets to founder-led scale-ups and cross-border insurtech. So he built the story, structured the model, and walked into the room when the terms are written. So today we talk about how this capital is shifting and how leaders need to shift with it. Thank you very much, Rob, for joining us today.
You're welcome. Thank you, Nuno, for having me.
Fantastic. So let's start with talking a little bit about the state of fundraising. What's your view on the current capital market landscape for founders and executives?
Yeah, thank you. Well, obviously, the markets are tight, but I think it's important to state that there are still funds out there looking for someone to place those funds. So it reminds me a little bit of the days, 20 odd years ago before we had the whole dot-com bubble burst, where people had very long return on investment models, very inflated valuations, and maybe some very optimistic business plans that did anyone really ever believe that they were going to happen? And I think we've now come a little bit back to that again, which is it's still very possible to go out there and raise, whether that's equity or debt funding. But the founders need to be better prepared. The investors are going to be much more detailed going through their due diligence, and we'll get into that. Yeah. So the money's out there. The valuations are still, I think, pretty decent and fair. Nothing's collapsed. You've just got to be, you've got to get your ducks in a row, and we can talk about that today.
Yeah, it's, as you said, there's been several times over the last 20 years where there's been more about investors buying the hype versus the discipline and so on. And that's what made valuations in some cases going crazy. We saw this recently in the markets where suddenly everything collapsed in terms of valuations. And so, as you said, is about being much smarter on that. The risk profile is different. The time to term sheet is taking a bit longer. So it's important because, as you said, in macroeconomical stage that people are much more focused on that discipline and taking that into consideration. What mistakes do leaders make when fundraising in volatile markets as we are living today?
Yeah. It might be that you could have got away with the mistakes 2 or 3 years ago, or prior to COVID, but they're still the same mistakes. The things that you need to do are still the same things that you need to do. And so for the building blocks are still the same. But as you said, nobody's buying hype. Yep. Doesn't mean that you can't find passion projects. You still need to get people excited. And we'll get into what people will get excited about. Leaders have to be able to build trust. And there's nothing worse than the founding CEO saying all the right things with an investor at that point, and then they get the first tranche of investment in, and then they're not making the effort with the reporting and the governance, and perhaps not using the investors' network as well as they should. Investor relations are going to be so important because you want them to continue to want to look after you as part of their A-list portfolio. Not someone who has grabbed the money and ran away and you never heard from them again. I say that because I've seen leaders who have been great at building trust and showed resilience, and that's where they continue to get support from their investors. And I've seen leaders who think they've played a game and they've been very short term about it. And then guess what? The investors aren't going to recommend them to their network. They might not follow the next round. They might be a little bit more picky and making sure that you're hitting your numbers and how you're allocating the funds. So, yeah, as you said, they're not buying hype. They do buy into trusted team. And what we mean by a trusted team is, I always think it's best if if you're a founder and you're being introduced to an investor or an investor network, whether it's a VC or family office or whatever private capital, etc., is out there, or even smart partnerships where someone might have a sweat equity or whatever like that. It's always great if it's come through some sort of personal referral and network where you've worked with someone before and they trust you, and it's a halo effect, right? The other aspect of the halo effect is your track record. So, like, no one wants to be the first one to buy a product in a market necessarily. Why would you go and buy a supercar from a new company that you don't know is going to be there in a couple of years' time? You go and buy the big brand one, right? So, but it's the same thing with investors. They don't want to invest necessarily in your first rodeo. So, if you've got someone who you trust, you've worked with before, maybe you've helped make them successful or they had a good exit together or something, let that person introduce you. Then when they come in, you then tell them about your track record in terms of, this is not the first time I built up and sold a business. And then the trust also needs transparency. So you'll also say, hey, I made mistakes along the way last time as well. I got lucky on this one. So you have to be human and show that you can learn, and also show that you're knowable and you will listen to external advice as well. That trust also has to be earned in terms of you're presenting business models and numbers that you might not have that much evidence of product market fit. You might not have that much evidence of commercial traction yet. So you need to be able to state your assumptions, and you need to be able to state those assumptions much more detailed nowadays. Yeah. In terms of really showing that you know the market. And then the other one is, if you've got things like order books and stuff like that, then great. So 3 main legs to this store, which is team. You need to have a good team. People invest in people, right? There needs to be a good market. So sure, you might be a market maker, but you need to be able to show that there is a market for this. At the moment, I'm not talking about problem and solution. I'm talking about the fact that there's the economic wherewithal for people to buy or invest in that product, that it's proven maybe with indirect competitors or something like that as well. So it needs to be a good market that's not saturated, or you're going to be competing with some incumbent that has a massive barrier. And then the third, so there's the team, that's the market, and then third one is obviously your solution, your product or your service. And when you talk about that, you need to make sure that it's a genuine problem that you're solving. You're not building a better mousetrap, and that your solution has, whether it's uniqueness, innovation, some unfair competitive advantage of some sort. That's it. I mean, there's probably got to be a bigger gap now between thinking these guys might be successful. Wow, right? These guys are really going to be able to corner that particular market segment. They're uniquely qualified, positioned, ready to be able to do that. So, sorry, that was a long diatribe from me, but yeah, I mean, really, those things haven't changed, right? Now, what possibly has changed is the dog and pony show investor deck, right? So go in and show a neat investor deck. I think a little while ago, a few years ago, people were probably being a bit fast through the due diligence. Both the seller and the buyer as such, or the founder and the investor, and that's for M&A as well as investment. And now it's not going to be enough just to have a pretty investor deck. You need to have the operational excellence behind that as well. And how do you show that? Sure, you still have the investor deck. Yep, that's fine. Sure, you still have a teaser deck before you send the long one, because you don't want to do death by PowerPoint. The other one is some techniques. So I'm working, for example, with Aya Capital, great Mexican industrial family, part of Grupo Modelo, with a large network of family offices. And one of the things that we've really witnessed in even the just last couple of months is how compelling video content is. So I'll sit down and do an interview with the founder, And we'll talk about all the things that we just mentioned, the team, their track record, the story, how did it come about in the first place? So you help them with the storytelling, the narrative, and then we talk about the market, etc. But then that video's there for people to watch and listen to. Then they can go into the deck. And ideally, you then give them a walkthrough on the data room. And so you need to have the data room ready now. Questionable whether you need to have a proper investor memorandum still. I like them. I think you have to be careful that you don't tie yourself up in knots with it. Make sure what you've written in there, you kind of believe in it and you can back it up. But that investor memorandum, even if it doesn't really ever see many people reading it, it does allow you to go through what we've talked about, the team and the market and all the rest of it, but also much more depth in terms of the roles you have within the team and the direct and indirect competitors, your 5-year P&L and all that sort of stuff in an investor memorandum where it's a story on its own. But then the data room, I mean, we could do hours just talking about what needs to be in the data room, but you've got to have the technical due diligence in there, which normally means someone's going to come and visit you, etc. as well. So what you've written in the data room, what you've added in the data room in terms of your, I don't know, your patents or, your architecture, all that sort of stuff, you need to be able to show that to someone when they come and, I don't know, code review you or whatever it might be, or meet the team. The financial due diligence, depending on what stage you're at, just to make sure that you've got both the historical records and with your future projections, almost line by line, backing up those assumptions in terms of these are the orders that we've got in the pipeline, et cetera, et cetera. Because if we're talking about equity, sure, we want to be able to see what the future EBITDA is going to be, but we also want to see what you're in for at the moment, what your current commitments are, what your burn rate is. So it's all of those things. And if you're in for things like debt funding, I don't know, maybe you're building a very inventory, capital intensive or capital intensive business, then you need to be able to model your working capital and state those assumptions. And that's not just about being conservative. It's also saying, this is one of the things that I quite enjoy doing this, is making sure that the founders have got the ability to fulfill a massive order that comes out. It comes through. Doesn't come through out of the blue, but it might have been a bit of a long shot. But if there's 10 long shots, then put it into the working capital, and then you're going to be able to fulfill it. So that's the technical and financial due diligence and the legal due diligence, which is, all of the basic KYC, AML stuff, but also just making sure that it's very clear to people that you've got good employment contracts, you've got good confidentiality clauses, you've got genuine agreements with your suppliers and your customers and all that sort of stuff. And that's a lot of work, to be honest. That's where I think, to do a bit of a plug here, this is why I think it's important. If their founder may or may not have that much experience in doing things like building a data room, there's quite a few people maybe done the investor decks and stuff, but have they ever built a data room because they've sold a business, or they've built a data room because they've got an investor really doing detailed due diligence? And I think that you can get support from that, even if you've done it before, but you don't have the time and wherewithal. I think it's really important that you empower your team. A lot of time I've seen founders only seem to be the one who have access to the data room, but let the technical, let the financial, let the legal, let the sales, etc. people have access to the data room where they can populate it and keep it up to date. It's not just one thing you do once, but then work with, coming to the plug, work with someone like MyFractionalCEO. So have someone come in and guide you through that. And I think if you bring someone as a fractional CEO or a fractional CFO or a fractional CMO or whatever that gap is that you need to fill, they can help with things like not just that data room, but the structure of everything and making sure that that structure is very clear. And that's part of the IM as well, as the organizational chart and how you've got maybe different companies within the group structured. So the MyFractionalCEO is one thing. The other one is obviously I work as a venture scout, as you know, for Aya Capital. But in reality, what that means is we're actually offering advisory services. I mean, we can't just go to the family offices and say, hey, why don't you invest in this? Is typically we are doing first pass on the due diligence, going through our own investor committee meetings, and then advising. And this is an important word, an advisory. Typically, you get your hands dirty. But it's different to a coach who would say, you need to have a data room. These are the things that you, and they don't even tell you what should be in the data room. They say, and what do you think should be in the data room? Yeah. As an advisor, you'll say, do you have a data room? No. Or yes. Okay, let's look at the data room. Okay, you need to add this, 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 this. Here's a template. I can help you with this. I can help you with that. So you're not doing everything for them, but you are getting your hands dirty and helping them with some things too. So I think between sort of my fractional CEO, the work I do at IO Capital with the advisory work as well, and then the other one, I don't want to do, I'm going to come back to coaching and consulting, but the other one, the key role out of having, say, an interim leader through to having a retained advisor, the other one is a mentor. And the difference being with a mentor is it's less about being hands on and it's more about having someone very impartial to work with. And I think that's quite good because that person is also the sort of person who might have that relationship with the founder to say maybe you need to give up some of these tasks to someone else, or maybe you need to make some tough decisions that you don't really feel that you can share with your team, but you can share anything with me. And so I'm working with a gentleman who met Nuno when we met up in the UK last with Andrew Bailey, and he's doing a fantastic job with as a mentor, and he and I have been cooperating recently on helping on M&A. So when companies are looking to grow through acquisition, so this isn't just about founders and investors, but also it's the same for M&A. It's much more detailed due diligence now. So you've got to be careful about who you're buying, and you have to be careful that you are presenting everything in a true light for the acquisition. You don't want to have to go through any legal battles of buyers as remorse afterwards as such.
So, and that was, I think, just that part there was a great cautionary tale and cautionary guidance, because the reality is, as you emphasized, things are the same as before. There's still money, there's still, and the things that are needed now are things that should always have been there. We just went through a time where over optimistic projections, where a little bit of hype and too much excitement kind of forgot that there is discipline. You need to have multiple projections. One of the things is about having multiple scenarios.
Yep.
Rather than only one. Let's have multiple scenarios. What is the situation if it doesn't go as well as you thought? What are the elements, the key head and tailwinds that you're using? And as you said, being very, very much backed by data, not by gut feels. And that is very important. And as you said, also sometimes getting that, even the weak investor targeting, where you go, I just want money. It's really about strategic investors, and investors are smart. The money is there. They just got hit several times, and now they got a lot tighter. And so you need to understand what you want. You need a strategic investor. And I loved how you placed the pieces about going, and there are different ways in which you can help. You can go from a fractional to an advisor to a mentor, which I think is important. Is sometimes what I see in leaders is, oh, I've done this multiple times, I know all of that. You always need someone to, even as a mentor, to go in and bounce some ideas and challenge you on those assumptions. So this part is very important. So once leaders are really grounded on what's shifting and this key element of discipline, data driven, and all of that, what should they do differently in terms of deal structures, for example? How do you approach now when we go into that structuring, the round and the story and so on? How do you approach balancing investor needs with the long-term capital resilience?
Yeah. Okay. I'm gonna come into the deal structure. I just want to pick up on one thing as well. In terms of, we talked about advice, we talked about mentors, and I said I would mention something about coaches and consultants. So there is a place for both of them. So leadership coaching, I think, is is something very important. Post an initial investment, an investor might suggest leadership coaching, say, for the founder, because maybe it's the first time, or maybe it's a slightly different industry or something like that. And that's why I say a leadership coaching can be very useful. A lot of the people who actually push back on the leadership coaching is probably the ones who need it, and the ones who embrace it, they just improve. I think consulting is I think it should be more very specific. So it's a very specific thing. It's consulting because you need FDA approval or whatever it might be. Because it's not a hands dirty role in that way, where someone will perhaps take responsibility in the business, but someone might help you get responsibility to, I don't know, get ISO or something. That's where the consulting works. Now, when it comes to the deal structure, obviously we're seeing a lot of use of things like convertible notes. I think that, yeah, and then we look at things like venture debt, which is very structured, and having resources that you can call upon when you need it. That's all structured out based on those scenario planning, as you mentioned. Nowadays, it's not just here's one whoopie-doo hockey stick model, but here's some scenarios, and if we achieve this, it's going to cost us X. If we achieve that, then we're going to need more working capital, etc., etc. So nice and transparent, lots of scenarios, not just scenarios to say there's good, bad, ugly scenarios, but if we succeed, we're not going to be afraid of success. So that structure around that is really important too. An interesting one, and I didn't actually think of it when I was preparing for today, but this came up a little while ago when I was doing some, we call it sparring with there's an accelerator in Finland for growth. And one of the investors there said one thing he looks for on the structure more and more so nowadays is to make sure that there's, these weren't his words, but I was thinking it more about an equity clawback. So effectively where you've got some founders who aren't pulling their weight, who are stuck with. And, all of everything we talk about when it comes to, it's not so much is it a buyer or seller's market, but being fair between the investors and being fair between the founders. It needs to be equitable, it needs to be fair, because it's a pretty much a long-term game. What I look for, ideally, is that there is a route out in 2 or 3 years' time, that there is a potential exit, that there is a potential strategic buyer. It doesn't have to take place. We might all be happy with the dividends and the growth that's happening, but it's still the same thing that we're looking for a step change in the valuation. So I think when we look at the shareholder terms and the investment terms, the debt structure terms, etc., we're planning for doing okay, and we're planning for success as well. And all of this is keeping those relationships through. So if the scenario doesn't quite go to plan, you're not playing catch up. It's open. You can see it happening in real time, and you're talking to the investors, etc. And then the other thing with kind of with the structure is what sort of investors are you going for in the first place? Because VCs will have certain restraints, but they'll also have good specialisms. Yeah, and they might have a portfolio that is complementary. Family offices a bit more discreet. They don't have a specific sum that they need to invest. They can perhaps react more quickly on some things, but they can also if you look for a family office like you do with the VC that actually knows your sector, so it's easier to have the conversation, get the valuation sorted and the terms that are acceptable for you. But they'll also be there to open up their network for you, whether it's distribution channels or suppliers or other investors as well.
Yeah, it's about getting much more than, as you said, is long term. And being a long term, it's about the partnership, not just I'll sometimes there are still founders that think, hey, yeah, it's just give me the money and I'm the expert, go away. No, it's a partnership. And of course the clawbacks are there and they are needed for both ends, because you don't want to have a founder or someone in your cap table, independent who it is, that is not pulling their weight. So smart money, strategic money, and with also the right planning between growth and cash conservation. Because one of the things that happened during COVID is that it taught us that it's important for us to have some reserves. So that is becoming more and more. And those scenarios, we're entering the foresight planning, where you have different scenarios, there are life scenarios, you keep tracking them. That's where it really balances that investor needs and the long-term resilience. One of the things, and you mentioned already on that storytelling, that is the narrative and so on, it's key. So what does a credible investor aligned narrative look like today?
Yeah. Yeah. Okay. So we're talking about what the founder needs to present, right? Yep. Yeah, because we can also look at it as a reverse pitch as well as what you should be looking for the investor. But we start with what the founder needs to be presenting, and this is tried and tested, right? Which is um, how did they come up with the big idea? How and why were they in a unique position to be able to embrace that opportunity? What have they done in the past that shows that they've got resilience? They attract good fortune. They have the right relationships. They've got the social capital. They've got the relationships with suppliers, etc., that they earn, and with customers that they can break into a market sector that others will struggle with. So their founder story is super, super important. How they came about and then why they wanted to do it. What their motivation is also really important as well. And then how they've managed to attract team members, because I personally don't like it when it's only about the founder. You need to show that someone is very good at bringing a good team in as well. And they've managed to attract talent that you think, wow, right? So occasionally a company will come along and I think, how on earth did you manage to convince the leader in that field or the leader in that field or the leader in that field to come in? And then they'll tell you how they convinced them because they thought the product's the best thing they've seen for X, etc. That same story is the one that you then is part of the narrative. Now, that's great, but narrative needs to be backed up with data. So, sometimes I'll interview the founder, which then gets presented back to the investors, and it'll be great, really, that's really good. And then I'll say, what multiple did you get for the business that you sold 2 years ago? And they might squirm a little bit, but then if they come back and say 100 times revenue or 10 times EBITDA or something like that, it's proven data, right? It's track record. They're not just making it up. So that's really important. So yeah, that story is all there, and then you obviously then get into the usual stuff that would be in the investor deck.
And yeah, it's as you said, is that clarity, and I would emphasize the team credibility. It's not a one person show. It's not about one visionary. Is the team credibility. If you are, as you said, if you show a team where an investor goes, how did you convince that? That is already something that is saying that you have something that people believe on. It's easier for an investor to believe if you were able to get some smart people. And so there's a whole thing sometimes where I'll get the team after the raise. Actually, that's the other way around.
Yeah.
It's a lot easier because it helps tell the story and so on.
Yeah. Yeah. Now, yeah, exactly. You need to have the solid foundations of the board, the advisors, the first show operational excellence, not give me the money, I'll go find people. No, no, no. You need to have them on board beforehand. But then what you just said, yeah, then you've done the raise, but then you also need already to be able to say very credibly why you're raising and what you're using that money for. Because right now, everybody's going to be very nervous that you're raising to pay for past down market, past loans against past burn rate, or you've missed too many optimistic targets, or whatever it might be. So, on the investor side of things, we're looking for positive cash flow. We're looking for a good team already in place. We're looking for an order book that is being fulfilled, but there's a lot more capacity to fulfill more, that it's still on an upward market trend, growth trend, where there's a good chance of a strategic buyer or flotation, or being able to attract the right kind of investment for even more growth. And that's it. You're investing for growth. So you want to find an investment target for more growth. And sure, if we're looking at things like deep tech and stuff, you have to take a longer term view. But then you look at what are the other funding sources they've had, where's the risk being shared, because that deep tech company might have been through a lot of difficult due diligence already with the Horizon project or other grant bodies, or yeah, or maybe some global consortium with big universities and stuff. So you're always looking for that that evidence that it's just going to continue to be going better and better, and your working capital is going to release that opportunity, not save them.
It's about getting that rigor from a financial standpoint, even in that investor decks and conversations, because it's as much about your forecast rigor as your use of funds rigor, but also showing, as you mentioned, who's on your cap table, because sometimes the cap table can make it or break it, because there are certain names that if you see there is great. As you said, you already went through a very heavy due diligence and everything. If they are in, more probable to go. But the other way around also happens. And so it's important for you now more than ever that the CFO is playing that role and ensuring rigor in terms of past use of funds, forecast, use of funds of this, and all the financial instruments that are required. But now, and you started talking about this, so let's gear now towards the investor relations and the relationship much beyond the pitch. So while you're managing this relationships, what builds a long-term trust? Is it transparency? Is it strategic alignment? What are the things allow that capital durability to be there?
The investor wants to find a founding team, a company that is highly compliant, that is very already has the numbers at their fingertips. So when you ask them for reports, it's there, it's already been done, right? It's not something new. Oh, I don't know, we have to report on that. So, really compliant, good governance in that business already. That's important. Patience, open communication. If the investor is asking not just for a report, but if something's going awry, not going to plan, tell them. If there's conflict within the team, tell them about it, talk it through. Investors can help in lots of ways other than just money. And those investor relationships are a long-term thing. So don't just think you only need to sort of turn up once a quarter or once a year or something and present something. Really utilize the network of the investor as well. Now, you mentioned the cap table. Utilize who's on your cap table as well, of course. But the other one is to slightly rewind. Sorry, it wasn't quite your question, but because you mentioned the capital, who's on and who's not on there. That's really important. If you don't have, say, investors that are well respected for your industry sector, have shown past success, maybe depending on what you're doing, is they're in the right country, ethically right positioned, etc., so that it doesn't prevent you from, I don't know, doing a NATO contract or whatever it might be. Yeah, isn't seen as a country that's at risk that someone's going to steal your IP. Yeah. So I've seen a lot of companies in the last few months trying to get people off their cap table because they're poisonous for them for winning new contracts in certain sectors. Simplicity in the cap table is nice. Do you really want to have pages and pages of entries on the cap table? If you have, and that's your legacy, then just be very clear to the investors how you communicate with those investors. And ideally, there's some syndicate approach behind it or something. Yeah. Yeah.
It's a very important point, because messy cap tables need to be explained. That increases the due diligence because it raises questions about why why that approach, and even sometimes how many raises have you done for pre-seed or so on, because that is already telling a story about how good you're forecasting. And
Yeah.
so that discipline. But now, when should the founder or CEO walk away from a business? So every now and then, and you mentioned what we've been talking about, I typically refer as you're after smart money, strategic money, and so that you can leverage the network and so on. But sometimes there are situations where you're talking, it might be a great investor, you would love to have it, but there are always things to look at from a deal structure and from what's in the table. So when should founders or CEOs walk away from a deal to prevent challenges in the future?
Yeah, there is an aspect of chemistry, right? So you do need to have that point where you feel like this is someone that you can have a difficult conversation with, and be pragmatic and practical and straightforward with that person. So you have to make sure that there isn't sort of personal clashes as such. Very human side of things. It might be some people don't necessarily have the soft skills, and that's fine. You can get coaching and stuff around that. That's okay. Most people are quite forgiving. But if you've got, to be honest, it's normally I've more seen the emotional IQ of the founders being more of an issue than that of the investor. Yeah, but who knows? Maybe I've seen examples of that, and that doesn't bode well. But from an investor point of view, I think we've all seen the young guy who works with the VC. He's got his master's degree and probably is one of 3,000 people. Yeah, 3,000 applicants. The only one got through, and then there's maybe some arrogance. And if you feel that there's too much arrogance from your investor, or they don't really necessarily know your sector that well, or perhaps, quite frankly, this is the reverse pitch. How well is their portfolio doing? How well is their fund performing? Is this their first fund? Be a bit careful, because ideally, if it's a VC, for example, it's their first fund, are they actually going to be in a position to be able to follow up on the next round? If they can't follow up on the next round, what's that going to look like to the other people on the cap table or to other external investors? So I would be nervous about working with inexperienced investors. I think that family offices are not all going to be the same, but typically you want to find a family office that shares your passion in what you're doing, and then you'll find them to be super supportive, super good at getting in with their network and expanding all sorts of things for you. Yeah. And that's something I really enjoy working with the guys at iCapital on, with the family offices. And so that isn't just about change in valuation and, EBITDA and all the rest of it. It is also about, is this a company that's doing something that we really believe in and, making a positive impact on society, etc. Because there's plenty of deal flow out there for them. Yeah. So
Yeah,
why not invest in something that makes you feel warm and fuzzy?
yeah, it's that value alignment, those passion for the problem you're solving, but also alignment in values, because you mentioned something incredibly important is having someone that comes in and around and is enabled to follow up is a very important piece, because for a new investor coming in and say, so is everybody going to follow up? If the answer is no, they just went,
Yep.
why? And so but from a founder and CEO perspective, and you mentioned it also, is that strategic. If you see arrogance, which sometimes comes up as aggressive terms,
Yes.
someone that wants
Yeah.
veto rights and all
Yeah.
kinds of things, just stay away. There is if you are going to on a very early situation, and I've had unfortunately that experience in the past, where you give too much power, because it also shows that you're really in need for money, because if not, you wouldn't do those aggressive deal terms, which is a red flag by itself. But
Yeah.
then it might actually prevent you from bringing someone else in, because then there is typically trying to clenching control. And that's a very challenging piece. So
Yeah.
that's for me very important.
And with all of this, so you're never giving away equity, right? You're selling equity in the business. And if you're getting to that point, you feel like you're giving it away or you're selling it below the value. I've seen some cases where some investors are coming on very aggressive terms, and then within weeks they've gone back out to the market to try and raise.
Yeah.
And it's like, well, why would we come in on those terms when these were the terms that you've accepted? And the founders are thinking, what's going on? And they've basically been led astray by those investors because maybe they're a bit desperate to pay some bills at something at that time. So it's hard to say to someone you shouldn't accept that investment because they might be having sleepless nights about paying a bill, but you've got to find another way because it's just going to kill the business later.
Yeah, but it also means that you need to be much more careful and structured about the rounds. So it's not about we need a couple of million for the next 18 months, so we're going to raise that. You need to be, again, based on foresight planning, you need to go, okay, there's multiple scenarios. I might need two. I'm going to raise five because of these scenarios, so that you don't need to go through those aggressive terms, because that can really, really hurt you.
Yeah.
Um, and and so let's finish with what's next for the economy and for leaders. So what's next in funding? So what's your prediction for how capital access and structure will evolve in the next 12 to 24 months? Do you see a shift to more alternative debt expansion, delayed exits, new hybrid instruments? What's your investor grade foresight for the next 12, 24 months?
One very personal thing, which is, I continue still as CEO for Null Venture, which is a software development house, but we're a bit unique because we're a venture builder as well. So one of the things that we have quite recently gone out to some accelerators and incubators and some startup communities, which is to say, we'll do some loss leader work for you to get you up and running because you might struggle to get all of the pre-seed funding to get your MVP out. And we also make an offering with that, which is if you want, you can use a sweat equity component. And if the market changes and your fortunes change and you've got revenue coming in or you've got investment coming in, you don't have to give us the equity. You can effectively pay for the work that we've done with an interest charge if you decide not to give away the equity. Because what we're doing is basically software development for equity. And we do a cash component, an equity component. Now, that's a very personal thing. Also, what's really cool, and we could have and anyone could come and approach and talk to me about this, is uh, also working with a colleague on media for equity at the moment as well. So if you're further down, so I'm talking about no venture helping people with their MVPs get up and running, or maybe enter a new market or create a new app. But then on the other side of it, you've got a product, you're out there in the market, you can grow, but you don't have the working capital for, um, the cost of acquisition, for example. So the media for equity is one of those models that's not new, but I think we'll start seeing that working better going forward. Equity investments will continue. Now, we've got a big angel network around the world, and we have things like European Business Angel Network, etc., and then regional like Finnish Business Angel Network, etc. I think they're a bit like LPs, general LPs, which is they're being quite cautious at the moment. They're trying to protect their portfolio, so maybe they're thinking more keep the money in my portfolio. That might be the case for a little while. But anyone who's had an exit of late, anyone who's had an exit maybe some time ago, has been quite cautious about investing, etc., then there's probably some very fair valuations out there. Uh, as we know statistically, all of the big FTSE 100 companies, and so I don't know, I don't want to quote statistics, I'm going to get this wrong. I understand that a lot of the big FTSE 100 type companies were actually born in recessions, right? So that's interesting. So I think if you've got investment money at the moment, it's not so much bargains to be had, but there's some very good fair values to be had, and maybe you can attract talent, etc., like that at the moment as
Yeah,
well.
and it's that they either are born in recessions or they become stronger in recessions, because that
Yeah,
shows who truly has the resilience, who truly has the
yeah,
talent in order
yeah,
to turn it
absolutely.
around.
So the companies that are doing quite well now will be doing fantastically well in a year or two. That's the sort of you know feeling. And then I think we will start to see well, we will see more debt funding as well. And I think that is, again, valuations are a bit soft, then that's a good route to go down. Interest rates have been at historical highs, but they've calmed down somewhat. I think if you can prove your case in terms of good inventory management, etc., then the debt funding shouldn't be cost prohibitive. And if it is, then this goes back to that whole thing that we talked about at the beginning, which is the team, the market, and your solution. Maybe your solution, the people don't really see the value in it if you can't make a margin on it enough to be able to fund it with the debt funding.
And that's an important part because there's more and more focus on what is going to be generated and some collaterals. And for debt funding, it's good to have a balanced approach between equity and debt because that also proves the experience of the
Yeah,
team.
yeah.
So, as a final question, and to close with a strategic point of view, what's one mindset shift that executives need to adopt for the next capital cycle from your perspective?
I hope this is based on personal experience, and I hope it's not too much based on just my own personality. But the CEO needs to think more like the CFO. So you've talked about data driven. It's the same. It's about numbers driven. It's about keeping good governance. It's about really keeping an eye on the numbers, really creating good, solid business plans with assumptions that are statistically valid. So CEO should be thinking more like the CFO.
Yeah, it's getting, of course, it should be visionary, but it needs to have the financial ability as a CFO in order to prove how things go, which is I absolutely agree.
But
So
I
Rob,
also with the challenge on the vision, right? Because you need someone with a balance between entrepreneurship, leadership, and management, right? And you still need people who will take a risk. But I think we're basically saying we're quantifying the risk. Yeah, we're still going to go ahead, but everybody knows about it now. I'm not hiding that. Yeah,
and it's being visionary is not being completely out of whack with reality, and that's the important part.
yeah,
A visionary is someone that has their heads in the clouds but their feet on the ground, and that's kind of what you're referring there is that yes, we need to have visionary people that are doing bets, strong bets, but that they are grounded and know we are doing this bet. Here is the risk. Here's how we mitigate it. Here's how we evaluate if the risk is getting too much. And here's some scenarios in which we can pivot. So I think that mindset shift of being feet on the ground and thinking like a CFO on that data and being much more, it's not pessimistic, but much more disciplined. I think it's
yeah. And I just throw in two more words, which is also operational excellence, right? You've got to be able to execute this because we're all going to be asked to be doing more with less, I think.
That's that's a famous word. You need to do more with less.
Yeah.
So Rob, thank you very much for today. This was a masterclass in readiness from terms to trust. Every executive listening now has a roadmap for navigating the next cycle without losing their long game. But it's if you're rethinking your capital plan, let's connect. Let's have the conversation. Connect with Rob, connect with us. He's already walked this road globally and can help you avoid some potholes as an advisor, mentor. It's about ensuring that you have the right support. Nobody is able to do everything by themselves. AI is there, and there's conversations about the next big billion-dollar company being one person and AI. Even then, you still need a good mentor, a good coach, a good someone to spar with because we're not there yet with AI. So follow Rob on LinkedIn, subscribe to this, the Value Multiplier series by My Fractional CEO with Rob, and let's continue in for a good raise and making sure that we build strong, reliable, long-term businesses because that's We desperately need that. Thank you very much, Rob.
No, thank you. And just to reiterate, please, anyone who listens to this, if anything resonates and you need some support, just don't hesitate to reach out. Yeah.
Fantastic. Thank you very much. This was the Valuation Multiplier talking about the capital in motion, fundraising, and strategy amid uncertainty. And in our future episode, we will be diving into the CFO role. We talked about this today. We'll go and dive into it because that role is also evolving into one of the biggest levers for growth. And there is so much to unpack there. So please subscribe and look forward to talking to you on the next episode, Rob. Thank you very
Thank
much.
you, Nina. Thanks.